Good day. My name is Siphiwe Mqadi. I'm an academic at the School of Accounting, Economics and Finance here at the University of KwaZulu-Natal in the discipline of auditing. Today we'll be looking at the examination preparatory workshop for your grade 12 accounting paper 1. Question 2. Now we are looking at the balance sheet and its notes together with the interpretation. Here you are given the list of balances or an extract as on 29 February 2020. You are given various figures that would ideally be on your statement of financial position or your balance sheet. However, there are a lot of missing figures and you have to work quite very diligently to then find and plug those figures in. It requires us to prepare the statement of financial position, 28 marks. And the first thing that you need to do, again, is to read the entire question. When you read the entire question, you will be presented with there's transactions over there where they ideally are testing your accounting equation or your knowledge of the general ledger. I do want to touch again on the accounting principles, being the assets increasing on the debit side, decreasing on the credit side, the equity and liability increasing on the debit side, on the credit side, and decreasing on the debit side. That's what it should say. All right, and the information that is also presented to you, just read all of it very carefully and make sure that you understand what is required from you. Again, comes your buyback share table. This is very important because what it says is in the information, it says that the board of directors authorized to buy back of 45,000 of the company's shares from existing shareholders, a repurchase price of 5 Rand above the average share price, meaning they've paid 5 Rand more than the normal price. An electronic transfer of 5,000 was made to shareholders for shares purchased. Do your share purchased table. You've got your ordinary share capital of 180. That is the 45,000 shares. Also, you are using your retained income, 5 Rand over and above. So that's 45,000 shares at 5 Rand. Then the whole amount you've used, 405,000 Rand. Now, the account that you will debit is your ordinary share capital because your bank, which is an asset, is decreasing and it decreases on the credit side. Again, your retained income decreases as well. It decreases on the debit side, and your bank is also decreasing on the credit side. So in this case, you just need to understand which account to debit and which account to credit. The next one is that Bright Sophie, the debtor who originally owed 32,000, has been declared insolvent. His estate paid 40 cents on the rent. The balance must be written off. So this debtor owed us 32,000, cannot pay, will not be able to pay. We're never going to recover the entire 32,000 because he's been declared insolvent, not in a position to pay. But his estate has managed to pay at first 40 cents in the rent. So what that means is we have received 40 cents of the 32,000 that it was initially owed by Bright Sophie. So the 12,800 Rand is an increase in our bank account. However, the 60 cents in the rent, 1 Rand minus 40 cents leaves you with the 60 cents, or you can say 100 minus 40 leaves you with the 60%, whichever the case. So that needs to be written off, and that's 19,200 Rand. So when you're now putting it in your information in your books, you say bank increases by 12,800 Rand. However, the debtor's control then needs to decrease because the people who owe us money are decreasing. Also, the bad debts, the amount that we're writing off of 19,200 is debited because it has the effect of decreasing our owner's equity. Also, your debtors control also decreases, hence it is credited. And then we come to now having to prepare the statement of financial position. Now, there is various information that is being given to you from the extract from the financial year end, the extract from the bank's reconciliation statement, the loan information, and then the net profit and taxation. Also, you are also given financial indicators, which are the ratios. So here, what I've done is you read your entire information, and you just need to be in a position to identify which information I can get first, because there's a lot of question marks, a lot of information that you need to plug in first before you can get another information in your statement of financial position. So I've broken it down for you. For example, your financial assets, which is a fixed deposit of 200,000, that's easy, that's a given. You're also given your current liabilities together with your retained income. All of that is given. I've put it, you plug it nicely in there. Then from the information that has been given to you, you are more likely to get more correct information or required information if you start with your equity and liability section. So if we start with our liability section, we look at the loan. The loan, which is sitting on C, you are given the balance of the loan of 920 together with the total repayments including interest. Now those repayments, they include the interest as well, but the interest that has been capitalized is 5,400, but the balance at the end, you don't know that, and that's what we need to calculate. So when you do your T account, you will have your loan amount on the credit side, the balance. Then you will have your total repayments on the debit on the debit side, because it's decreasing your loan, hence the minus. And then you will have the interest that has been capitalized. It's increasing your loan account, a plus of 65,400 rand. Now, the 88,200, if you can look at the calculation at the bottom, it's the 153,600, which is the total repayment including the interest. You need to deduct the interest so that you can find out how much of the current liability portion that I need to move to my current liability. You'll understand that with your statement of financial position, presentation also has got a lot of marks. So how you present the information, you cannot leave that 88,200 under your non-current liabilities, because now it becomes your current liabilities. The information under the note says the capital repayment will remain the same in the next financial year. So that 88,200 is expected to be paid in the next financial period. So you move it very nicely under current liabilities as the current portion of loan. Number 3 on my reference there. And then the fourth one, you do the SARS, very simple. You've got the opening balance, the closing balance, and then the amount of SARS balance there is 15,000. Number 5, you've got your bank overdraft. Now with the bank overdraft, if you look at B, your the extract from the bank reconciliation, you've got a post-dated check. A post-dated check, what basically that means is that you have drawn a check in the current period that you are dealing with. However, the person or the payee will not be able to cash the check only up until such time that is stipulated on the check. And the time that is stipulated on the check it relates to the next accounting period. So ideally, there will be no effect on the bank in the current year. Though you owe it in the current year, but the bank is not affected. Therefore, you need to add to remove the 5,000. The bank overdraft is sitting at 20,000, and then you move the 5,000 to the current liabilities under your trade and other payables. Hence, you will then say 440 plus 11,500 and add the 5,000 which you owe in the current period, but will then be paid in the, or rather the check will be cashed in the following accounting period. That is number 6 of 456,500 rand. Now, when we move again swiftly to number 7, you've got your shareholders' equity. Now you are given the information, your financial indicators. When you look at your debt equity ratio, your debt equity ratio dictates that you look at your total debt over the shareholders' equity. So you've got that shareholders' equity portion in that ratio. So what that means is you will need to take the 743,000 and then multiply it by 0.65, which is the ratio, and that will give you the shareholders' portion. So the debt is your loan, you multiply it by the 0.65, because what happened initially was it was total debt over shareholders' equity. So they divided initially to come up with that 0.65. But when you work back, you have to multiply when you work back to then get the shareholders' equity. The next one over there that we're going to look at is your ordinary share capital. Then it means you are able to calculate your ordinary share capital because you've got your shareholders' equity, you've got your retained earnings, deduct the two, or rather the difference between the two gives you your ordinary share capital. And then we move to number 10. You've got your current assets. Now again, you have to refer to your financial indicators. You've got your current ratio. And it will click in your head to say, my current ratio is made out of a current assets versus current liabilities. So I am able to get my current assets from that figure. So what you do, you use your current liabilities to get the current assets. And your current liabilities are 884,700 rand, then you multiply by the 1.5 because we would have divided the 2 to get the 1.5. So when you work back, you multiply. And that figure gives you the 1.3 million rand. Then the next thing that you are able to get as well, as per the information, you are told on your financial indicators that trade and other receivables amount to 58% of the current assets. So you just multiply by the 58% because you already have your current assets figure. And then you move again swiftly to your number 12. Now number 12 is or rather on my reference on the side, which is 12, which is those are inventories. They're a bit tricky but easy. If you understand your asset test ratio, that it has current assets and it deducts the inventory, and that's what you need. You want the inventory amount is to your current liabilities. So you can now use the financial indicator, which is the asset test ratio, by saying 1.5, which is the current assets on the ratio, you deduct the 0.9, it gives you the 60, the 0.60. Then you multiply that by your current liabilities to get the figure of 530,820. All right. Then another figure that you are able to get as well is your cash and cash equivalent. Your cash and cash equivalent, you understand that it sits in your current under your current assets. So your cash and cash equivalent, you take your current liabilities, you multiply by that financial indicator of 0.9, then that will give you the sort of like the entire figure less inventories. And then what you do is you need to then just deduct 769,689, which is the trade and other receivables. Then that will leave you with the cash and cash equivalents, which is number 13. Your fixed assets, more or less like a balancing figure, because you already have your 2,772,300, and you just need now to work back. So when you work back, it means that whatever is shown as a negative, you will have to add it. Whatever is shown as a positive, you will have to deduct it, because you're working back. And that gives you your figure of 1,445,250. Again, when you go back to your equity and liabilities, you do the same thing. You just work back, because you've already gotten all your other information except for the shareholders for dividends. Now that will be the missing figure that you will need to add and make sure that you get the 305,000. Okay. Also, a bit of theory as well on this part of a question. All the questions actually will have some theory in it, hence I keep on stressing the importance of theory. So the theory here is, what type of audit report did Ekuvukeni Ltd receive? Give 2 reasons for your answer. You can clearly see that the financial position is fairly presented. Therefore, you may assume that they received an unqualified audit report. Unqualified meaning that the company's financial statements are fairly and appropriately presented without any identified exceptions. That's the auditors that give that report. And where is the report, to whom is the audit report addressed, and give reasons for your answer? Normally, it's given to shareholders as owners of the business and those charged with governance. And then the reason, ordinarily, okay, sorry. Yeah. Ordinarily, the auditor's report on general purpose financial statements is addressed either to the shareholders, because they are the owners of the business, or to those charged with governance of the entities whose financial statements are being audited. In this sense, that would be management. And then the last question on question 2 will be, explain why the auditor mentioned the following in the report. IFRS, International Financial Reporting Standards. This is a source of globally comparable information. IFRS standards are also a vital importance to regulators around the world. And IFRS standards contribute to the economic efficiency by helping investors to identify opportunities and risks in the world, thus improving capital allocation. If a business conforms to IFRS standard, it means that each person around the world can be in a position to pick up those financial statements and make economic decisions based on the financial statements presented, because they conform to a uniform standard, and that is IFRS. The Companies Act is abiding by the laws, stipulated standards, and maintained by shareholders' investment, and is safe, and it also creates investor confidence in the company. The Companies Act stipulates the manner in which financial statements must be prepared. So it details, it is a standard or a law that needs to be followed by companies, and it details various aspects of a business or the financial aspects within the business. And it makes stakeholders sleep easy knowing that that company conforms to a certain rule of law. So they are not doing anything outside of the norm. The next question that we're dealing with now is question 3, and that's the last question in this question paper. Again, it starts off by giving you 2 columns, matching of column A with column B. You are given various options on there. First, you are that they give you is trade unions. Now, it just boils down to your understanding of what is trade unions. It's those individuals or a group of people that monitor whether their members are being paid fairly. That is the most appropriate option out of all of those. That's not all that they do, but it is the most appropriate option on the column B given. Then SARS, D is the most appropriate answer, needs to be assured that the income tax is levied on the net profit correctly. You would have heard me saying that SARS makes an assessment and they tell you how much that you are owing. That's exactly their main function, because they want to collect taxes in as accurate and efficiently as possible. Shareholders, they want to be assured that their investment in the company is used wisely. That is, option A is the most correct option over there. Then the next question requires you to prepare the retained income note. Again, these are your note to your annual financial statements that you will need to understand and know how the entire note is prepared. You are already given the balance at the beginning of the year, and you are already given dividends that have already been paid out during the current year. And those figures are 560 and 27,500. They are already in your answer book. What you need to then plug in is to find out what net profit after tax did the company make. And from the information that has already been given, you are given the income tax. And they are saying the income tax is 90,000. And from that 90,000, it is 30% of the net profit before tax. So that 90,000 is the 30% portion of tax. Now, if you want to find out what is the amount before the tax, what you need to do is you need now the 70%. So here you're dealing with two percentages. You are given the 30%, that is the 90,000, but you want to find out what's the 70% to make a holistic 100%. That is net profit before tax. You take the 90,000 that is given to you, you multiply, meaning that you multiply by 70 what you are looking for, and you divide by what you are already given, which is the 30%. So it's 90 times 70% over 30. Then the next thing, the information that they gave you is the share buyback. Now that share buyback is pretty simple. You want to find what's the difference between the 9 Rand and the 7 Rand, because the average price initially was 7 Rand, but we were able to repurchase these shares at 9 Rand per share. So the difference between the two, of which is 2 Rand, that's the share buyback. That's the amount coming out of retained income to finance this repurchase. And then dividends. Dividends are also pretty easy. It's quite an easy question to work through, because you are given the financial indicators, and there is one important financial indicator over there, which is the dividends per share. That deals with how much of dividends have we paid. Now, there's 270,000 shares that are out in issue. Then when you multiply by 34 and divide by 100, you want to find out how much of dividends have we paid to the people who already hold or own shares in this company. And that comes out to 91,800. Now, the 91,800, you've already paid an interim, which is given, of 27,500, and you then need to take the 91,800 and deduct the interim dividend that has already been paid. Now that will give you the dividends that have been declared but not yet paid. So these are the dividends that were declared at year end but not yet paid as yet. And then the balance at the end. Now, the next question again, which is 3.2.2, that looks at as an existing shareholder, you are given obviously the information. The company intends issuing an additional 100,000 shares in the next financial year. The directors propose that the fair issue price would be 10 Rand 20 per share. So for 4 marks, as an existing shareholder, what financial indicators would you assess in determining whether the 10 Rand 20 per share is a fair issue price? And then provide reason. The financial what financial indicators you want to see, the financial indicators depicting the trends. How has the share been, the share price over the years, so that you can make a clear distinction to say, okay, the share price, it's fair compared to previous year. The trend is fairly okay. There's no major issues within the company where the share price skyrockets and then all of a sudden drops, because that would be sort of like an indication of business not performing quite favorably. Then the next one is a shareholder. Siphiwe owned 43% of shares in issue on 30 June 2019. Calculate the minimum number of shares she must purchase in order to become the majority shareholders. If you own over 50%, it could be 51, you are a majority shareholder in that company. So you want now to make a calculation to then tell Siphiwe to say, if you buy an additional so many shares, you will be a majority shareholder. And I've put a note there to say, note anything above 50, that's majority shareholding. So she currently owns 129,000 shares. That is 300,000 multiplied by 43%. So to be a majority shareholder, you need the 370,000 times 50 plus 1. So that one just tips her over to making her a majority shareholder. And she therefore needs 185,001 shares. So she currently has 129,000, therefore you minus the 185,001. Therefore she needs to additionally buy 56,001 shares. Then she will become a majority shareholder. Next question. Kostrim, the CEO, has suggested that Siphiwe should be given the first option to purchase the additional shares before they are advertised to the public. What advice would you offer to the directors concerning this proposal? Very important. If it is a publicly traded company, shares should be publicly and freely available to everybody. So that nitpicking the suggestion by the CEO to say they need to be given to Siphiwe first could be an infringement of very strict insider trading laws, and that is illegal and also unethical. So you need to follow the legislation, and this needs to be followed by everyone. The directors must apply the rule of law to safeguard the integrity of the business. And insider trading is also illegal and unethical. 3.2.3, share buyback. We've been talking a lot about this in this paper. I'm sure you will most probably be in a position to follow now, because the question requires you to outline why companies buy back shares from time to time and explain the two benefits of share buyback. Contrary to popular belief, share buyback is actually more often than not a good thing. because it improves the net asset value, which could impact positively on the market price of shares. Also, it improves the earnings per share, which creates a better image of the company. It improves the dividends per share, hence the shareholders presently will there will be less hands to go by in as far as dividends are concerned. So they will be satisfied if they are getting relatively more from the plate, from the one plate of dividends. If the management decides to pay a certain amount of shares, it means you will get your share in accordance to the number of shares that you own. And if the plate is more and there's less of you as shareholders, it means there will be more to go by. And that's good for shareholders. It shows that the company is also solvent and liquid. If you are able to take your own money as the company and buy back the shares, it means you have money. You have no issues when it comes to solvency and liquidity. Now, also 3.4 3.2.4, quote, 2 financial indicators that indicate an improvement in the liquidity position of the business. Liquidity, meaning the business has money, has sufficient money to pay its current liabilities as and when they fall due. But it's not liquid if then they are not able to meet their current liabilities. So the first one is your current ratio. Current assets is to current liabilities. The current ratio has increased from 1.4 is to 1 to 1.9 is to 1. So they have more current assets to go by, and that is clearly depicted from the 1.4 move to the 1.9. And then the average debtors collection period has decreased from 57 days to 38 days. Now what that says is, if I extend credit or if I sell my goods on credit, businesses want to collect in a relatively shorter period of time because they need that money. You sitting with that money, they want it back. So if they can decrease the collection period, it is very, very good for the business. So those are the 2 liquidity indicators. And then the last 2, the company paid back a large portion of the loan. Explain why this was a good decision, and quote 2 financial indicators. 1, your debt equity ratio will decrease because you're owing less long-term loans. Okay, so there's lower financial risk and there's it's low geared. Meaning, falls back again to that example that I make to say, you as an individual, if you are able to have debt and meet the obligations as and when they come due, then it is good. Your credit rating is going to be good. More and more people or suppliers will be willing to extend credit to you. Okay, so goes with the business as well. The return on average tangible common shareholders' equity has also decreased from 22.3 to 20.8, which still positively geared as it is greater than the interest on the loan. The loan interest is 11%, but and it's sitting at 20.8. So the interest that we incur on the loan is more than the return on average on tangible common shareholders' equity. And the last one is now you calculate the dividend payout policy over the past 2 years and provide possible reasons for the current policy adoption. In 2019, in your information over there, you need to look at your dividends per share, because that will tell you your dividend payout policy. How have you been faring off comparing to previous year? So in previous year, your dividends per share was 52 cents, and then you divide that by your earnings per share of 63 cents, and that is 82.5%. In 2020, you have your 34 cents as your dividends per share, and you divide it by the earnings per share of 84 cents, which gives you 40.5. So a greater percentage was retained in 2020 for future expansion purposes. So in 2020, they retained the majority of the dividends because most probably they're looking out for future expansions or whatever that the business would ideally want to do with excess cash that they would decide to keep from time to time. I would like to, that's the end of the paper 1 on accounting. Thank you very much. I'd like to thank the university, the College of Law and Management, under the School of Accounting, Economics and Finance. That gets us to the end of paper 1. I hope you've enjoyed it and learned something, made notes for yourself for easy reference when you want to go back and study. Next, we'll be dealing with paper 2, looking at your reconciliation, bank reconciliation and debtors reconciliation together with cash budgets and also cost accounting. Do stay tuned.